Welcome back to Indianomics. This is our monetary policy special, and I have been speaking with Amandeep Chopra of UTI Mutual Fund, Sajjid Chinoy of JP Morgan, and Soumya Kanti Ghosh of State Bank of India. Amandeep, you stirred the argument right by saying this time around perhaps it is liquidity that the market will really watch out for and not so much inflation signals. I think the inflation trajectory will also be important, but what else will you actually look out from the governor?
I think largely this budget from a rate perspective is going to be a non-event. I don't expect an announcement on that. But I do expect the governor to do highlight a lot of risks, especially on the external side. Clearly the world has started on a very soft patch in terms of its growth outlook. We've seen the revision from World Bank. China continues to be a worry. So I think a lot of these risks will be highlighted, and from a policy perspective, I think it's possibly going to happen well after the budget.
Okay. On liquidity itself, what exactly will you watch out for?
So I can't think of any specific provision in the policy itself, but clearly RBI has been stating in all its monetary policy statements that they would want to ensure adequate liquidity in the system, and they have been actually doing that. Barring certain, I would say, periods of time where the government has actually held on to very large balances and has created a bit of a spike in overnight rates. I think RBI has handled liquidity fairly well during the current financial year.
Okay. Well, Soumya, the prior periods when the Reserve Bank was very generous with its OMOs in the period of 2012 and 2011, we ended up harvesting double-digit inflation as well. So, do you think the Reserve Bank has too much of a elbow room for open market operations?
No, see, I agree with your point and Sajjid's point to some extent. At the end of the day, the yields are remaining high, and that is also to do with the state finances. And if I go by that logic, that if suppose there is no OMO in the market, the yields are going to stay at these high levels, at least in the current fiscal, because right now the problem is not with the central fiscal deficit. The problem is actually lying in the state deficit. And if you add up all those discount bonds, the next year the total amount could be more than 9 lakh crores. Now coming back to your point of whether the OMO in the years of 2011 to the inflation was such high levels, I think the inflation levels started to rise in 2019, and that was because of structural issues. And if you remember, in 2012, when the government actually overshot the fiscal deficit from 4.6% to 5.7%, the yields had spiked to 9%, the 10-year yields. And at that point, the repo rate was at 8.5%. After that, there was a systemic liquidity injection, and the 10-year yield was actually brought down to 8.10%. So what I am saying is that just to smoothen the market nerves, because at this current scenario, the fiscal scenario, the state bond issue, the huge supply of government bonds outstripping the demand is also going to come down because the SLR is coming down. So the banks are not going to invest that amount of money in the government bonds. So if you take all these factors into consideration, some sort of market, it could actually suit to the market sentiments, and that is the downward movement in 10-year yield is absolutely necessary for the banks to transmit also. Otherwise, that scope will become limited. So, appreciating the fact that maybe the RBI may think that the OMO could not be the correct signal, but I think at the end of the day, you need to do that so as to give the signal to the market that there has to be some sort of transmission also on the part of the banks.
Okay. It's just that at this point in time, that might mean 1 trillion rupees, so that's a little scary in terms of the amount of base money creation. But very quickly, we'll be running out of time, so I want to ask you, we are now exactly 12 months from the March 2017 or Jan-March 2017 period where the Reserve Bank has set the target of 5%. What do you expect that number will be? Will the Reserve Bank be able to guide for a sub 5% like they did in the monetary policy report?
No, I think the RBI has actually done a very commendable job in terms of dealing the inflationary expectations from becoming generalized. For example, if you look at the core price numbers, the core CPI inflation, that has nicely settled down to the level of 4.5%. So I think the RBI has so far been able to guide the market very properly, and I don't see any reason why the inflation numbers is going to be within the RBI level of 5%, because as of now, apart from the pulse prices, all other vegetable prices seems to be well under control. So I think that the central bank, and with the help of the rain gods, I think the glide path could become more meaningful and operational into the next fiscal year also.
Sajjid, similar question to you. What do you expect the Reserve Bank's fan chart to look like? My sense is they have to give a 12-month forward inflation number. What do you expect them to forecast, and what's your own forecast?
Latha, two quick things. They've already given a number which is sub 5. If you look at the September review, the average inflation for first quarter of this calendar year was 5.8. The average inflation for the first quarter of 2017 is 4.8, and average across the year is 5.5. So already they've committed to a number which is below 5. My suspicion is, since if you add up the events in the last 3 or 4 months, in some, the forces are disinflationary, so I expect that the indication will be that the first quarter of 2017, inflation continues to be under 5%. I won't be surprised if they signal downside risks to the 4.8 number. Very quickly, our own forecast is just below 5 for 2017, suggesting there is some room opening up for easing. And I'll just make a quick point on the whole discussion on liquidity. The proof of the pudding is in the eating. To the fact that the overnight call rate has by and large been very close to the repo rate for most of this year would suggest that the banking sector has been infused with enough liquidity. If there was a systemic liquidity shortfall, you would have seen the overnight call rate diverge significantly and sustainably from the repo rate, which has not been done. I think that's ultimately what you have to judge liquidity conditions by.
All right, we'll have to leave it at that. Thank you very much, gentlemen, for joining me. Key takeaways then from my guests. This time we will watch for what the RBI says about liquidity as much as what it says about inflation. 2, does the RBI think the market liquidity is appropriate, or will it hint at more open market bond purchases? Our experts are divided. Soumya thinks RBI can buy at least 20,000 crore of more bonds to replenish the money that was drained out by dollar sales. Amandeep thinks market needs some soothing given the sulfate of bonds from the centre and the state governments. But Sajjid Chinoy is firm. It is not the Reserve Bank's role to monetize the fiscal deficit. If the market is telling the government it has no appetite for more government bonds, that is the best way to impose fiscal discipline. I would broadly agree with that position. Third takeaway in this context, Reserve Bank's comments on the fiscal deficit for next year will be important. Will it be stern about the 3.5% fiscal deficit target? My guess is it will be. Fourth takeaway, the Reserve Bank will also warn the government against accepting the EPFO's recommendations to increase the interest rates on Provident Fund from 8.75 to 8.95. If you remember, the Reserve Bank warned the government last time against higher small savings rate. The government hasn't so far obliged, so that will be watched for. Point number 5, the Reserve Bank's comments on the trajectory of CPI will obviously be important. Will global commodities decline accelerate the fall in domestic inflation? Those comments will be important. Point number 6, the Reserve Bank's take on India's growth. That will be key. Does it see FY16 as delivering the 7.4% growth that was forecast? Will it expect FY17 to be better? And finally, will the RBI get more strict or more lenient with bank bad loans? As you can see, not a policy of major action, but it will be a policy rich with cues and clues to understand where the economy is being steered. Well, we will be there on Tuesday to present the monetary policy to you. Thank you very much for joining us on this edition of Indianomics.